Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve at Sipe & Associates. Beginning, as I always do, with saying thank you. Thank you for your service to me, to everybody in my family, to Ed, to all of our team, all the people in the country. You don't hear it enough. You'll always hear it here. Again, somebody somewhere, I'll probably see it on Facebook this week, that will say, shouldn't thank federal employees for their service. I just delete them off the feed. So that's just the way that's going to happen. Not picking any fights, but I'm going to keep saying it until everybody says it. And you will always hear that here. The other thing you're always going to hear is the guru. Ed Zurndorfer is back with us as part of our ongoing mission to reach, teach, and serve you. And at the outset, I always need to say the opinions of our guest, Ed Zurndorfer, no matter how awesome they are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have one, hit us up at Serving Those Who Serve. We will do what we can to help you. As always, we follow Ed's FedZone articles to give us one more way to reach and teach. So we're covering a couple of topics here. And one is, I've always got a lot of opinions on this, so I'll try and keep myself tamped down, Brother Ed. The first is a primer to what I think is a pretty important topic, and it's a new addition to the Thrift Savings Plan called the Mutual Fund Window. Ooh, we'll explain what that means. And the second is just one of Ed's golden contributions every year is the annual list of questions Fed should be asking themselves before they prepare their tax returns. So we'll have this out there in time for you to do that. So first things first, let's jump into this mutual fund window. I've been tracking it for a lot of my career. This thing's been knocking around for nearly 20 years. And, we've been tracking it, and we got our first posts up pretty much as soon as it hit the register as being finite that it could take place. And we'll be sharing and explaining more as the details become available from the FRTIB. But again, been knocking around for a while. Looks like it may happen this year. So for starters, new contractors coming into the mix. It's a group called Alight. The group is a good-sized provider of options like this in the 401k world. So getting to your article, Ed, let's begin with what is a mutual fund window, and are they common out there?
Well, let me just say this, that the TSP will not be the first employer-sponsored qualified retirement plan to utilize a mutual fund window. The private companies with their 401k plans, 403b plans have been using them. And what a mutual fund window is, it's a self-directed brokerage account that gives retirement plan participants the option, I emphasize the word the option, they don't have to do this, it's strictly up to them, of buying shares of outside open-ended, also known as mutual funds, selected by or for their retirement plan. Okay. Mm-hmm. In other words, with the TSP, TSP participants will have the option of investing beyond what they currently can invest in, what I call the 5 TSP core funds, the C fund, the S fund, the I fund. Those are the 3 stock funds, and the 2 bond funds, the F and the G fund. Okay, and of course there are also the life cycle, the L funds that are combinations of the five funds, and then they go beyond that with a separate brokerage account. Okay, now what TSP participants really have to keep in mind is the fact that unlike the 5 TSP core funds, the investments available through the brokerage account, and we're talking, Dan, I was told about 1,000 funds, about 1,000 mutual funds out there, open-ended funds.
I heard it could be as high as 5,000.
5,000. These funds are not going to be vetted by the TSP to determine if they are, can I use the word suitable investments, or appropriate investments for the typical TSP and participant. The TSP participant, it's strictly up to him or her to decide if they want to participate. They're on their own.
Due diligence.
Okay.
Yep.
And I mean, that's really the good news that now the TSP participants had this opportunity to go beyond the TSP, because one of the complaints about the TSP is there are only 5 funds. Mm-hmm. I really like to have something else beyond that. I remember about 10 years ago, maybe a little longer, when real estate was really hot. This was between 2006 and 2008. It was not as hot as in the last couple of years. And there was such pressure on the TSP to offer, and a lot of the pressure came from, guess who? Congress. It'd really be nice if you offered a real estate fund, a fund that invests in real estate, or like a real estate mutual fund, or a real estate investment trust, a REIT, because those funds are doing great. Look at some. Wouldn't it be nice if you did? And the TSP stood its ground and says, no, we're not going to do that. And one of the arguments was why TSP doesn't do it is that if we start opening up the TSP now to real estate, who knows, maybe orange juice futures, gold futures are going to really take off. We should start offering maybe an O fund for orange juice, or gold funds.
Sure.
What's the limit? What's the limit here? Most importantly, if you introduce more to the TSP, more available in funds, it's going to drive up the costs. This is one of the big virtues of the TSP, low expenses.
Very true.
When you introduce more, that means somebody's got to pay for it. And who's going to pay for it? The participants.
Yes.
So that's one main complaint about the TSP. It has limited funds, but with the limited number of funds comes the low cost, and they are still somewhat diversified.
Yes.
What I advise individuals is, look, when you retire from federal service, you can take some of your TSP and directly transfer it to a IRA. That's allowed. Yep. And you can invest in anything you want. There's your opportunity.
Yeah, I mean, technically speaking, they could even do some of that at 59.5. So
that's correct. That's correct.
It's the TSP is not a straitjacket. It's not locking you in, saying you can never take money elsewhere. I have noticed, however, that the TSP has now developed a marketing department. So you go to their site and it almost looks like you're looking at a place that gathers assets, because they're telling you all the different ways you can roll other things in. But let's stay on the mutual fund window. So you said there's more. You already started with it. There's more options, but also additional fees. Let's talk about those. Walk us through them.
If I can just list what these extra fees are going to be, okay? For if you do this, again, I emphasize this is only for individuals who choose to participate in the mutual fund window. Those federal employees and retirees who decide they'd like to participate in this mutual fund window, they're the only ones who are going to be paying these fees. There's going to be an annual maintenance fee of $95.
Gotcha.
Listen to this one. There's going to be a per trade fee of $28.75.
Ouch. Sorry. Did I say that out loud?
Yeah. Go ahead. There are going to be fees and expenses imposed by specific open-ended. When I say open-ended, I mean a mutual fund, as opposed to a closed-end fund, a mutual fund, in which the participant chooses to invest. In other words, a TSP participant may choose to invest in a specific fund that has its own fees.
Absolutely.
Okay. And then
an expense ratio. Yep.
And then I like this one. This is the other fee. There's going to be a fee designed to guarantee that the mutual fund window will not indirectly increase the share administrative expenses paid by participants who choose not to use the open-ended mutual fund window.
Gotcha.
Note once again, those TSP participants who invest only in the TSP core funds, C, S, I, F, and G, or the L funds, will not be charged these extra fees associated with the mutual fund window. But the TSP participants who choose to use the mutual fund, they're going to be paying an extra fee to make sure that the TSP participants who do choose not to do not pay the extra fees.
Gotcha.
That's a total of 4 extra fees. Okay.
Yep.
Okay.
Yep. I'm coining a new term, Ed. I'm coining a new term. I'm calling the people who are staying with the original core funds, I'm calling them legacy TSP. the legacy TSP people are not going to get socked for this right now.
Dan, you're talking to one of them.
Yep.
I retired from federal service on January 31st, 2006, and I had a nice amount of money in my TSP account. It's still there. It's grown a lot since then, but I haven't done anything with it, and it's going to probably stay there for the rest of my life. My wife is my beneficiary. We're going to use it because it's simple, and main thing is it's not expensive. Sure. I'm a cheap guy. What I tell investors.
Ed, you're also a CFP, so you're kind of your own advisor too. Let's be fair about this. You are Ed Zurndorfer.
I can't forget. I guess I can't forget that sometimes.
Oh, you can't forget that. Come on, you're Ed Zurndorfer. Okay, so you talked about the additional fees. Looks like there's some restrictions to it too. Why don't you touch on those?
Oh yes, we cannot forget the restrictions. So those TSP participants who decide they want to participate in the mutual fund window should be aware of the following restrictions. Number one, the TSP. This is a proposal to require someone who wants to put money into the mutual fund window. It has to be a minimum $10,000. Okay. That's the initial. For the initial investment in the mutual fund, $10,000. Okay, the initial investment cannot exceed 25% of a TSP participant's total TSP balance. So what that means is, putting the two together, that if a TSP participant who wants to participate in the mutual fund window, they must have, for starters, at least $40,000 sitting in their account. At least $40,000, because 25% of $40,000 is $10,000. When they want to make subsequent transfers of the mutual fund, into the mutual fund window, those subsequent transfers cannot exceed 25% of their balance at the time of transfer.
Okay.
So that's in a nutshell what it means to get things rolling and to continue to fund the mutual fund window.
Gotcha. And then they'll extend the current rules about the number of trades per month to the mutual fund window, correct?
That is correct. So currently, this has been the rule since I think 2008. One is allowed to make 2 inter-fund transfers. We're talking about the C, S, I, F, and G fund. You're allowed to make 2 inter-fund transfers per month. However, after the second inter-fund transfer, a TSP participant can always transfer money from the C, S, I, F, or F fund into the G fund. There's no limit as far as transferring money into the G fund. Okay. But what they have to keep in mind, that any transfer between the TSP core funds, if you want to transfer money from your TSP core, any of the TSP core funds into the mutual fund window, that will count as towards the monthly limit of 2 interfund transfers. That will count.
Gotcha. No, that's an important note. And Ed, did I read correctly in the register that no matter what you do, your first step when you come out of those TSP core funds is you go into a money market before you can go into the other mutual funds? Did I read that correctly?
I did not quite see. Maybe I guess
we'll dig into that further, folks. Yep. Because there's a lot of information flying. We're all digging at it from different directions. We will run that to ground, and this will be the place where you can get those answers. So, I mean, here's where I come down on this. I'm always in favor of things getting better. So, for example, when the I fund was slated to become the whole world minus the U.S. It was going to be super low cost. It was going to cover the entire international marketplace. I was all in favor of that. But then politics got in the mix, worse than I've ever seen it. And it was, these senators were saying, no, that includes China, and we don't want that, and that type of thing. And then it just kind of stalled. And then we came into the new administration, and almost within weeks, we were hearing political drumbeats like TSP has to go carbon neutral, and TSP, has to do this, or TSP has to. Congress was never supposed to be involved in saying what you can and can't do with your money, feds. They're just not. They're supposed to, and the Retirement Thrift Investment Board is supposed to provide you with a comparable and competitive plan to other great employers out there. So here's what I think, Ed. I think that they were just getting batted back and forth on this, and I think this was the solution that they had in front of them to say, hey, you know what, Congress? Here you go. If somebody wants to go into emerging markets, and that includes China, they can go do it here on their own. Or if somebody wants to go to environmental and socially conscious funds, here you go. They can do it here. So if that becomes a release valve, and as a result, Congress isn't trying to push the TSP to go one way or go the other way, then at the end of the day, I think it's a net positive. And folks, here it is. This is just Dan being Dan, but it boils my blood. When you hear a legislator referring to TSP funds as federal pension dollars, that's incorrect. This is money that has already been given to you as part of your compensation. And you have the right to make investment decisions about it as you see fit to benefit you and your families. The political cause or issue of the week should not get in the way of your well-being. That's my point of view. That's Dan's sermon, and it's over now, but that's where I come down on it. Ed, do you have any thoughts?
I do, in the sense that that everybody, like, and we teach this during our financial. We have a financial planning webinar. We have a TSP webinar. The key is, what are your goals? If you are a TSP participant, what are your goals in terms of your TSP account? Do you want it to grow? Okay. Are you willing to take risk on to get that higher return? Understand the fees. Okay. Mm-hmm. Know what you're doing. If this is something you feel you're capable of doing, okay, and it'll hopefully make your goals, or achieve your goals, it's a great opportunity. But for those individuals who have no interest in diversifying, they're very satisfied with what they have with their TSP account. I'm one of them. Mm-hmm. So be it. So be it.
Sure.
But once again, I tell individuals in terms of investing, they want my thoughts, and I give them my thoughts, and I talk about the usual risk-return relationship. This is my CFP background, and and I also tell them about the fees. And what I say to them is that, please do not concentrate so much on what the potential return is on your money. Don't concentrate 100% on that. Think about what's going to be left when it's all said. It's not, I always say, it's not what you're earning, it's what you're keeping. When you add in the fees, the extra fees, are you really achieving that investment return when you include the fees? It's so important. And that's just where the TSP, I find, TSP is in my way shines in the sense that it has very, very low fees. There's no commissions. No one is really profiting per se. The expense ratios of the funds are extremely low. And look, once again, if you do want to maybe diversify, and that's an important part of investing, diversifying your portfolio, like we talked about real estate. That's why, starting at age 59 and a half, you can transfer a part of your TSP account into outside mutual funds through an IRA. You have that opportunity. Yep. So keep these choices in mind.
Absolutely. Absolutely. And the other thing, because I work with Ed, and I know how much he has invested in his knowledge. And it's a little bit, when he talks about working with TSP on his own, it's a little bit like listening to Edison talking about the wiring in his house, because he could build the doggone thing. So Ed is an extraordinary do-it-yourselfer. He really, really is. There's probably 30 years of his life invested in that. If you're not looking to invest 30 years of your life, we're happy to talk to you at Serving Those Who Serve, because Ed is a unicorn in some ways when it comes to that. So now, Ed, let's roll into your 8 questions for Fed to ask before preparing taxes. And the first one, we've talked about this in previous podcasts, and it's kind of a deal for this year, is the advanced child tax credit. So what should Feds be considering here?
Well, there are some Feds who were the beneficiaries of getting a advanced child tax credit payment starting last July. It showed up in their bank accounts in July through December, and those payments were, if they had children under the age of 17. And the payments were based on what they got with the fact that their income for 2000 and 2020 was low enough that they qualify for these payments. However, it may turn out that their income in 2021 is going to be larger than it was in 2020, which means that those extra payments they got for the child tax credit have to be returned. In other words,
ouch,
any refund they're going to be getting on this year's taxes will be reduced, and if they owe money, they're going to owe a lot of money. Now,
ouch.
Here's the problem, Dan. As you know, I'm an accountant.
Mm-hmm.
And I have a checklist. I tell my clients what you have to give me in terms of stuff you received, documents you received, things that happened to you during the year. And one of the problems it has been in the past, and it still is, that client says, I don't remember getting that payment. I didn't check my bank account. Money was put in my check account, but it's usually gone because my spouse usually spends the money before I even see it. So how did I know I got the payment? So to get around this problem, the IRS decided they're going to send out a letter to anybody who received any amount of an advanced child tax credit payment starting last July. It's called Letter 6419. It's the IRS Letter 6419. It should have been sent out in January, notifying anybody who got a payment of advanced child care tax credit anytime between July and December 21. That's the amount they receive, because it has to be reconciled on the 2021 tax return. There's something called a Schedule 8812 or Form 8812 that preparers have to fill out, showing the amount of the advanced child tax credit they got and how much they were actually eligible to receive. And that will determine if they're going to have to pay it back or they can keep what they got, depending on 2021 income.
Gotcha.
My younger son, he and his wife have one child, and they did get the payments. And he just told me he got the letter, in January. So he's going to give me that letter together with all their other tax stuff when I prepare their taxes. However, I've been told by another client, I never got the letter. I never gotten any letter. Okay? They came to me in early February to get their taxes prepared. So the person said, what do I do? I said, it's very simple. Go to your bank statement. Every bank statement you received in July, August, September, October, November, December, and see, it should have a direct deposit from IRS. That will tell you if you got those payments. Just bring me a copy of your bank statement, okay?
Gotcha.
So this is going to be very interesting, this tax season, I predict, because some people did not get those letters, and preparers have to do something to reconcile the payments if they got them, okay?
Gotcha. So number 2, I know, is just one of your absolute favorites from your tax practice. It's your favorite thing in the world to talk about, and that's cryptocurrency.
Oh, I'm waiting. Maybe the TSP is going to offer cryptocurrency as
you take that back. You take that back right now, Ed Zurndorfer.
It's kind of right. But IRS is coming down hard on this. And one of the first questions you have to answer, right on the top of Form 1040, have you dealt in cryptocurrency? You better answer the question, yes or no. Yes or no.
Yeah.
If you say no, great. But if you said yes, be prepared to report any transactions that you had used with cryptocurrency. IRS is getting very hard about this, okay, in the sense that they're using extreme measures now to find out who's using cryptocurrencies. I mean, this is being used to buy goods.
Sure.
You can go to the restaurant and pay for your meal using cryptocurrency. And these are taxable transactions.
Absolutely.
At my end of year tax seminar, the person who gave the seminar said, cryptocurrency is going to be IRS's next foreign reporting income project. The foreign income, you got it for the so-called FBAR.
Sure.
The special thing you have to file, if you have a foreign bank account or foreign investments over a certain amount, I think it's $10,000, you got to report that on the FBAR. Well, IRS is going to have a new project called cryptocurrency, in which anybody who deals in cryptocurrency is going to have to file a special form every year. It's coming.
Sure. No, it makes sense. Makes sense. And okay, so up next is the economic impact payment recover rebate credit. That's a mouthful. What do feds have to watch out for here?
Oh boy. Okay, so last March, as a result of the passage of the American Rescue Plan Act, so American Plan Rescue Act. Okay, eligible individuals got a $1,400 stimulus payment. Now that $1,400 is per family. So
gotcha.
If you're a family of two, you got $2,800 payment. If you're a family of six, you got $8,400 payment. But the payment that was paid out automatically by IRS was based on 2020 adjusted gross income. If your AGI was below a certain amount, you got the payment. If your AGI was over that amount, you did not get the payment. But once again, this is for 2021. So that when you file your 2021 taxes, and let's say you got that payment because your adjusted gross income was less in 2020 compared to what it turns out to be in 2021, that money, you will not have to pay it back. That's the good news. You do not have to pay it back. Okay?
Gotcha.
However, suppose you did not qualify for the payment based on 2020. Maybe your income was higher in 2020 than it is in 2021. So now you do qualify for it. On your tax return, I think it's line 30, it's called Recovery Rebate Credit. There is a worksheet that compares what you got, the amount that you got, and compared your AGI for 2020 versus 2021 to see if, in fact, if you didn't get it or you didn't get the maximum amount, then now you qualify to get it or to get the full amount. Now, I will tell you, accountants, here we go again, have to ask the question. Did you get a recovery rebate credit? Rebate credit? I really need to know the amount for me to do your taxes. I asked a couple clients. You were supposed to get a letter from the IRS. This is another IRS letter 6475 that was supposed to have been sent out in January, early February, notifying you what you actually received in terms of that third economic impact payment. Oh, I didn't get the payment.
Gotcha.
I didn't get the letter. Well, one of my clients' income was in fact too high in 2020 when there was no issue. Of course, they're not going to get a letter because they never got the payment. But I had another client who got some of the payment based on the fact that they were very close to the upper limit of the adjusted gross income for 2020, but now their 2020 income is much less, and they'll get the full amount. So I asked the person, did you get the letter? I said, no, I didn't get the payment. I said, please go to your bank statement. Go to your bank statement, March or April. They went to their April statement. They found that payment. And now they got the full difference. They got the full amount. They filed their taxes using, this is IRS form 1040, line 30, which you have to go into a worksheet entitled the Recovery Rebate Credit. Lots of fun, Dan.
No, I can see that. And I noticed something. All your clients sound the same when they say they didn't get the letter. It's always the same voice. No, I didn't get the letter. So let's move on. Number 4, did our Fed refinance?
Oh, big year for refinancing.
Sure.
2021, 2020, and 2021. Let's face it, interest rates were rock bottom. What's the lowest in 40 years, 50 years or something, Dan? Interest rates. A lot
Indeed.
of people decided they're going to refinance their mortgages, okay? And the question comes up when they refinance the mortgage, the new interest that their new mortgage that they got, they're paying interest, is that interest going to be deductible? Well, let's be careful here.
Yep.
The Tax Cuts and Jobs Act of 2017 did a whammy on the issue of whether you could deduct mortgage interest.
Yep.
And here's what the law says. Only the interest paid, the amount that was borrowed. You're paying interest on the money that's borrowed, and that borrowed money was used to buy a house or to make capital improvements can be deducted. Okay? Mm-hmm. Okay? And if, let's say, they refinanced and took out more money than they really had to in order to refinance the old mortgage, before the passage of the Tax Cuts and Jobs Act of 2017, they could deduct the interest on the additional $100,000 as what is called a home equity. It's home equity. Interest paid on home equity loans up to $100,000 was deductible. In fact, was. And what is the purpose of a home equity loan? What do people take out home equity loans for?
They could do it for home improvements, but sometimes they use it for kids' education, buy a car, take a vacation, pay off credit cards, things like that.
Yep. Way to go, right? Can't do it anymore. Those are out. That's out. So, and they got this issue. They got this IRS has this policy about, it's called tracing one's mortgage interest. As a tax preparer, one of the things I have to ask the client, let's say they refinance the mortgage, I said, now, what was the purpose of the refinance? The person said, I got a great interest rate. I was paying, I had a 5% interest rate, and now the bank gave me 3%. And I said, did you refinance what was left on the old mortgage? Yeah, and I took out a little extra to pay for closing costs. I said, no problem. No problem. Now your interest is going to be deductible. One person said, well, my old mortgage, I had $200,000 left, and I took out a $300,000 mortgage. I took out $300,000 when I refinanced. The payments with the lower interest rates were lower. And I paid off the old mortgage, and I used the other $100,000 to buy 3 cars and took a vacation. Ooh. I said, go. I said, we cannot deduct the interest. What one person said to me. Okay. And I asked him, what was the purpose of the refinance? Would you believe, you know what the person said to me? None of your business.
None of my business.
None of my, and what I said to the person.
And yours was, then I'm not doing your taxes.
No. No, worse. I said to him, you're right. It really is none of my business. Therefore, I'm just not going to, you're not going to be able to deduct any of the interest if I do your taxes because you told me it's none of my business. Yep. Therefore, I cannot legally put down interest that I have no idea whether it was really legitimately could be deductible. You're right. Person got really disgusted at me, walked out. Fine.
Oh, well. Well, let's move on to a happier thought because number 5 is my personal favorite, charitable deductions. So what tips do you have for our folks? What questions should they be asking?
As a result of with the COVID back in March 2020, Congress passed some additional legislation, and one of the several pieces of legislation, one of which was that for 2020, Congress passed a law that allowed individuals who do not itemize, as you know, Dan, for those people who itemize, they file Schedule A. What is included as part of your itemized deductions? You have medical expenses that exceed a certain amount. You have state and local taxes. You have mortgage interest, charitable contributions. Yes.
Yep.
So suppose you do not itemize. It turns out that you don't have enough itemized deductions, and you take what's called the standard deduction, and you make a charitable contribution. Well, before Congress changed this law, somebody who did not itemize could not get any tax benefit for making charitable contributions. Not that should be one's motivation to make a charitable contribution. You know what I mean? Let's be honest with one another. You make charitable contributions because it's the right thing to do, not that you're getting a personal benefit from it, like a tax deduction. All right, but that being said, Congress decided to make individuals at this time when people really needed help during the COVID. Congress passed, as part of the legislation, allowed individuals who take the standard deduction. They can take what's called an above the line, this is an adjustment to one's income, deduction of up to $300 per tax return. That was for 2020. Whether you filed as single or you filed as a married filing jointly, you were only allowed a $300 above the line deduction on your taxes if you did not itemize. Now, for 2021, it was changed to $300 per filer. So if you file as married filing joint, you got a $600 deduction. But however, it is what they call a below the line deduction. That is, the $600 is deducted from one's taxable income. Okay.
Gotcha.
For 2021. Couple things to keep in mind. Whether you're getting a $300 deduction for 2021 or $600, the contributions have to be either in the form of cash or a check or a credit card. If you made any donations of goods, old furniture, to the Goodwill, the Salvation Army, they don't count. We're talking strictly cash check donations here. And please make sure you have a receipt for your donation. Very important.
Yep. Okay, number 6 could be a big one. I'm hoping most feds didn't need to do it, but that would be CARES Act distributions from retirement plans. Yes,
it allowed the CARES Act, which was passed right after the start of COVID, in March 2020, allowed individuals to take distributions from their qualified retirement plans, and that includes the TSP. They could take money out of up to $100,000, okay? And, of course, they had to pay federal and state income tax on the amount withdrawn with no early withdrawal penalty if they're under 59 and a half, okay? Those individuals who took advantage of it, and I say qualified retirement plan, also, please, we have to include traditional IRAs also. Traditional IRAs, you could take up to $100,000 from your IRA. Now, individuals who had made these withdrawals, they had the option of paying the income tax due on these withdrawals over 3 years. They could actually pay the liability over 3 years. And also the option of paying back the funds. Here they took the money out as a loan. Normally, as they took the money out, it was a withdrawal. Now, they're going to consider it to be a loan, which means they pay back the loan. So, in fact, if they pay it back within the 3 years. They pay the amount they took out within 3 years. Then, if they did in fact pay the taxes, they'll get a credit on their 2021 return. A 2021 tax return. Actually, they actually have until for I think up to 3 years to pay it to pay it back. And if they're on their 2020 return, they reported the full distribution. As taxable, they can amend their 2020 federal and don't forget state tax returns and they'll be able to get money back as a result of amending their returns.
Gotcha. Now, number 7 sounds like it's tricky. Unemployment benefits, but not for the Fed, for their kids? What do we need to watch out for here?
Oh, boy, this is interesting. I say this COVID really resulted in some dependents, children of federal employees. Hey, let's say college kids and high school students.
Sure.
Let's face it, a lot of them were not in school. They were home. They had jobs at the, at the mall, or maybe they had jobs maybe working, just part-time while they were in school, okay? But they lost their jobs. They lost their jobs, and they were entitled to receive unemployment benefits, okay? Mm-hmm. Now, the question I had, and that was I put in this column, was: are the parents aware of this? That they actually got unemployment benefits? Because those unemployment benefits are taxable. Okay. If they had received any unemployment benefits during 2021, then those unemployment tax benefits that the child received has to be reported on a tax return, and it's going to be taxable, both federal, maybe even state tax return. Normally, they don't take out any tax on unemployment benefits. So if we're talking a substantial amount, the child could be really stuck with a nice amount of a tax liability. So please communicate with your children. Find out what they did.
Absolutely. And last but not least, you've got hobby income. So give us some examples of that and why we need to be careful with it.
Well, another result of COVID-19 was the fact that people had a lot of time on their hand, unfortunately. And they maybe started to pick up some hobbies or side jobs. So, a hobby turned into a job, and they maybe give me an example. Maybe they were fixing furniture. Sure. They were very handy. They told people around the neighborhood, if you have any broken furniture, I'll be happy to fix it. I got all this equipment here. I'll fix it up like new. Sure. And they made some dollars in there. So the question that comes up: they took in money. Do they have to report the income they took in as income? Is that as income? Well, you can, on your tax return, there's a line that says other income. I think it's Schedule 1 on Form 1040, other income. What is other income? Anything that generates money that you put in the bank in one way or another is considered to be income. Income is income. Now, what some people don't understand is that, yes, income has to be reported. But my example here, the person fixing up furniture, they had certain expenses. They maybe had to buy tools, right? They had to, maybe they use part of their house exclusively. They can have some, maybe entitled to depreciation of the house, the tools, that will cut down the size of their income. But the point is they have to file a tax return reporting it, okay?
Gotcha.
And I say, one of the questions I said, federal employees who have family members who like children who may have started a hobby and generated income, you have to ask them, how much income did you make? And did you have any associated expenses with it? I'll never forget a couple years ago, this goes back a while, when we used to get some significant snowstorms in this area. And one year, this goes back about 20 years ago. One year, it snowed almost every week. And kids in the neighborhood were shoveling snow, making a lot of money. So my next door neighbor said to me, my child made probably it must have been about $5,000 this winter in shoveling snow.
Wow.
And he knows I'm an accountant. I don't do anybody in neighborhoods tax returns. He just went and asked, is that reportable income? And I said to him, yes, it is. Yes, it is. Does my son have to pay tax on it? And I said to him, yeah, income is income. Is there any way he can avoid paying tax on that? There's a way that he could reduce it, but I'm not going to say avoid paying taxes. But I'll make a suggestion to you that, how old's your son? Oh, he's 19 years old. 19 years old. I said, okay.
Oh.
What I suggest he do is that for all the people that he shoveled snow for, we're talking a lot of people in the neighborhood, that how about you and him going around the neighborhood and talking to all these people and see if they can pull their resources together and do the following. To give your son a W-2. A W-2.
Gotcha.
And he said, what is that going to do? Well, okay. This way, he can start his life the right way and take all that money he earned and put it into an IRA. An IRA. And let's make it a deductible IRA. A deductible.
Yep.
Well, that contribution reduces his income. This way, he won't have to pay any taxes. Oh, that sounds really good. Now, what is this involved in? Again,
and folks, this is what happens when Ed Zurndorfer is your neighbor. Just remember, understand this. Don't try this at home, people. Go ahead.
So I said, you got to talk to the neighbors. They got to pull their resources. That shouldn't be a problem. But because now he's an employee, they also have to hit their portion of the Social Security tax and unemployment tax all together. I'm sure that won't be a problem. So my neighbor said, is there any other thing we could do? I said, the only other thing you could do is just consider it to be other income, and this way he has to pay tax on the whole thing. Never heard what happened in the end. But as you're right, Dan, don't talk to me. I have lots of ideas.
And don't try this at home, folks.
I'm just looking at my calculator now. The son at that time was $5,000, the most he could put into an IRA. And I'm looking here, he puts it into an IRA. He's 19 years old. He can't touch it until he's, let's say, 59. If he's 40 years later, until he's 59. So I'm looking at my calculator now, 40 years. And let's say he's getting, I'm going to use conservative 7% per year. 7% per year over 4 years. That $5,000 will grow to almost $75,000.
Yep.
Wow. The power of
compound numbers,
of compound interest, and so on.
Yep.
Something to consider. And ladies and gentlemen, it's not too late. If you have children who got a W-2, when they work, maybe they worked over the summer, the fall, or Christmas vacation, whatever they did. Okay. Start them off the right way. Tell them about IRAs, particularly Roth IRAs. Oh, my favorite. Roth IRAs. Over time, the money's going to grow. So this is what we learned. This is what we learned. Work hard, and get a paycheck, and use that paycheck wisely, both now and in the future.
Right. And remember, Ed Zurndorfer is a trained professional. Don't try this at home. Always get help. So, my friend, you've helped a lot of people with this one and the information that you have in the Fed Zone, and we're very grateful for that. I've said before, you are a treasure to us and the federal community. We appreciate what you do, and especially what you help us learn. Well, folks, that is a wrap. We are serving this to serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Share it with friends and neighbors. Check us out on Twitter and LinkedIn. Don't forget the live webinars every week. We will be dropping some nuggets out there about this mutual fund window as it keeps coming. And you can find those webinars at scwserve.com. Big blue button, click it. And the guru will come to you. Sign up for one, sign up for all, share it with friends. They will thank you. Read Ed every week in the Fed Zone. That's at fed-zone.com. So for Ed, the crew at Serving the Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving those who serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.